Rick, we saw, what, almost 3 million foreclosures, and that is even as processing delays, both from industry and regulatory reasons, spared financial end results or year-end statistics. With pink slips ranging from anywhere from 3 to 6 months, how long is it going to take us to work down that inventory?
We're going to be in this soup for a few years. We did have about 2.8 million households receive a foreclosure notice last year. That's up 20% from last year and 120% from 2 years ago. So we've doubled in 2 years. And the reality is that it would have been a lot worse except for those delays you were mentioning. So we're going to have an overhang of probably 500,000 homeowners who will go into foreclosure in 2010 that would have gone in 2009. Mm-hmm. Unemployment is going to drive high levels of foreclosure activity well through the end of this year. And we have another batch of fairly toxic loans that are due to reset starting at about the midpoint of the year. So 2010 will in all likelihood set yet another record for foreclosure activity before things settle down a little bit.
I think there's statistics out there. There's about 2 million vacant homes, or 20 million vacant mm-hmm. homes with shadow inventory coming down the pipeline. Does that surplus have any silver lining to the economy at all?
The surplus doesn't have a silver lining per se, but I think the reports that you're reading about the doomsday scenarios where all these properties hit the market and we have a smoking crater where the housing market used to be are overstated. Most likely scenario is that what we'll see the lending community do is very gradually and in a very measured manner release these properties back into the marketplace. Mm-hmm. They know that by flooding the market they're going to damage home prices for the rest of their portfolio, so they have some motivated self-interest to hold things off. And I know the administration and the Treasury Department are working with the banks to try and monitor and measure this so that we don't have a double dip home price in home prices.
It'll all be predicated on how and when those banks can sell those homes.
And at what price? I mean, one of the reasons we've had these delays is because the lenders simply can't afford to take all these losses right now. So a lot of what you're seeing in terms of delays are either subtle or blatant attempts to sort of defer the losses to a later date. And as the bank's books get better, I think you'll start to see more of these properties move.
Given this, what do you think the downside in the valuation of housing is for the rest of the year? Do we have 5% more to fall, 10%?
I think it's going, I know it's a cliche about real estate being local, but I think in terms of price points, mm-hmm. you're going to see wide local variances. We really believe that the market's going to be largely flat for the next couple of years. So you'll see either a very, very nominal drop in prices or a very, very nominal gain in prices, with some markets doing better and worse than others. I know that's your basic middle of the road forecast, but we do not see another 10% price decrease at this point.
So you talked a bit about unemployment. I guess the foreclosure market generally lags that by mm-hmm. a year, with layoffs still coming, wage cuts. Are we in for doomsday?
Well,
I mean, we haven't, obviously, I mean, if you look at it that way, we haven't seen the worst of it.
We haven't seen the worst of it. And while 2010 may be the record year, we hope, for overall foreclosure activity, we'll probably see more physical bank repossessions in 2011 as this whole process works its way out. So no, we're not at the end of this yet. The economists that we talk to think that you'll see one new foreclosure action for every 6 to 10 jobs lost eventually. Mm-hmm. And the eventually is the key word here in terms of how long this lasts. But assuming unemployment peaks sometime in the first quarter of this year, we should see the tail end of those foreclosures probably by the end of 2010 or the first quarter of 2011. And then things can start to settle down. So
you're thinking just more of a steady decline, mm-hmm. flattening off towards the end of the year. What are your arguments against double dip? I know John Malden is saying that, David Rosenberg.
The people that are looking at a double dip based on shadow inventory are taking the absolute worst case scenario. There are about 500,000 properties the banks have repossessed that aren't on the market. There are 1.1 million properties in foreclosure. There's 5.5 million delinquent loans. If you add all those up, you're over 7 million potential distressed properties. And the scenarios I'm reading about are all 7 million of these things hit the market as distressed properties. And if that did happen, mm-hmm.
Given that that's more properties than we're going to sell over the course of a year, we would have a smoking crater where the housing market used to be. Reality is,
Those 500,000 properties the banks currently have aren't going on the market all at once. Of the 1.1 million properties, probably less than half of those will ultimately go back to the banks. And of the 5.5 million delinquent properties, a lot of those will never go into foreclosure. So that real shadow inventory is probably more in the neighborhood of 2.5 to 2.8 million potential distressed properties. And they won't all hit the market at once. There's a lot of pent-up buying activity. These properties are at price points that make it very attractive for first-time home buyers and investors. A lot of bargains to be had out there. I think the real gating factor in all this is when the banks will start lending again. And if that loan money is available, I do think you potentially could even see a recovery, much less a drastic fall off in home prices.
Now, in terms of mortgage rates, have housing prices fallen, below the mortgage where the refinancing is not an option?
Two ways to look at that. If you're buying a house, the interest rates are at record lows,
right.
So that's a good thing. And the combination of that and the price drops have been extraordinary. Buying level or the affordability levels at all-time record.
That's if you're buying.
If
but
you're buying, now, if you're a
home.
homeowner, and that's what one of the problems is with these loans that are going to be resetting this year. In a lot of cases, these homeowners are 40, 50, 60, 70% upside down on a loan that they took out 2 or 3 years ago. So it's not the interest rates per se, it's how far the home prices have depreciated in a short period of time. So they can't refinance those. They can't sell them because in most cases they can't afford to take that kind of loss themselves. And the banks really aren't willing at this point to do a principal balance reduction. So it's a pretty toxic soup.
So when the Fed stops buying mortgage-backed securities in March, what is that going to do to rates?
That's a really good question. That's the one that nobody has a real good answer for. And I guess, I'd have to answer the question with a question, which is, if it looks like that's going to be a calamity in the making, do we really think the Fed's going to stop buying those notes? So we'll see. I know the Fed's going to do everything humanly possible to keep rates as low as humanly possible, because they I think underestimated at the beginning of this cycle just how devastating a disaster in the home market would be to the overall economy, and I don't think they're going to make the same mistake twice.
So in the data that we've seen, without massive government intervention in the housing market, there essentially wouldn't have been a housing market. Is that
That's
correct
still the case. If you don't qualify for an FHA loan or a conforming loan that Freddie Mac or Fannie Mae will buy, there is no lending going on. There is no secondary market. And I think until we see the market convinced that home prices have stabilized, which makes mortgage-backed securities a safe investment again, and we have money coming into the secondary market to fund jumbo loans, we're going to be in this sort of stasis mode, and everything's going to be really flat and icky, a technical term we use, for the next couple of years.
Finally, one last question. We actually posted your report yesterday on the site and showed the heat map, if you will, of where foreclosures are happening. And one observer said, from the map, it's crystal clear that Obama supporters are the biggest deadbeats of them all. Thoughts?
Ouch. No, I think unfortunately...
Four states are 50% of the foreclosures.
4 states comprise 50% of the total. But there are a handful of other states that on a per capita basis have much higher rates of foreclosure. Nevada, 1 in every 10 homeowners is in foreclosure right now. That's just unprecedented. I don't think, whatever your political leanings, you can really blame this on Obama or his supporters. In fact, what we're dealing with are loans that were made before the last election. And what the real culprit here, if you're looking to pin blame, there's blame to go up and down the food system. Homeowners who bit off more than they could chew, got into contracts they shouldn't have. Realtors and mortgage brokers who put people into houses and loans they couldn't afford, lenders who ignored their own underwriting standards, Wall Street who fueled all this fire, and then the regulators who apparently were asleep at the switch. So every safeguard in the system failed at the same time. I think I've said before, when the CSI detectives get around to the corpse of this housing market, they will see Wall Street's fingerprints all over it, but the cause of death is going to be greed.
Thank you, Rick.
My pleasure.